Um, let's go ahead and jump into Chapter 16, which covers control systems and quality management techniques for enhancing organizational effectiveness. When you, as you'll notice through any business management textbook, for the most part, any of the introductory ones, the concept of control systems will be repeated in more than one chapter. It's because it's such a weighty topic that it cannot possibly just be condensed into one chapter. If you feel like, wait a minute, we've heard about this, yes, you have. And of course, when we talk about planning, organizing, leading, and controlling, here's the depth and breadth of it in more than one chapter. So we're going to go into some of the different techniques so that you can see how organizations use these systems and techniques in order to be effective. There are several questions that you should be able to answer by the time you are done studying this chapter, such as why is control an important managerial function? How do companies that are successful implement these controls? How can 3 techniques, which are balance scorecard, strategy maps, and measurement management, help you as a manager establish standards and measure performance within an organization? And what are some of the financial tools that you need to know about? Something else is to consider how do top companies improve the quality of their products or services? What are the keys to successful control? Some of those barriers that keep control from being successful. And then, of course, how do managers influence productivity within the organization? So let's jump right into control. What you as a manager do to get things done with controlling is shown in relation to the 3 other management functions. They're not lockstep. All 4 functions happen concurrently. So you have the planning, organizing, leading, controlling, right? And controlling is defined as monitoring your performance, comparing it with your goals, and then taking any corrective actions that are necessary in order to help you reach those goals. So figure 16.1 shows you controlling for effective performance. And you'll see that planning is you set the goals, you decide how to achieve them. Organizing, you arrange the tasks, the people, the resources that you need to accomplish the goals. Leading is what you do to motivate people in order to achieve the goals. And controlling is how you monitor performance, how you compare it with the goals. And of course, like I said earlier, take any corrective action needed. So you make any necessary tweaks to make things work. All of those lead to effective performance. So why is it needed? Why do we need it? Why is this such a vital part of any kind of goal attainment? And the thing is that it helps you adapt to change and uncertainty. Remember, I've said plenty of times before that change is a guarantee. It's gonna happen. And so you have to be able to adapt to change, and you have to be able to adapt to the fact that certain things are going to come out of nowhere. You may have a plan A, B, C, but have you come up with a plan D, E, F, right? Something may just happen. Something may fall through. Something may break. There may be a change in the economy or the political system, or there may be a death of a stakeholder. There's so many different things that can happen. So control is needed for there. Discover irregularities and errors. When you have a control mechanism in place, you're then able to track and see when something was done incorrectly, but also if there's an irregularity. So if you consider a production line, for instance, and all of the products are supposed to look and assemble a certain way, and then you notice that some of the products are not looking like the others, or they're not assembling the same way. That's an irregularity. Those are the ones that you then pull out. Those are defects. So things such as that. Control is also necessary to help keep your costs low, to increase productivity, or to add value. To detect, detect various opportunities. Opportunities to be able to have a competitive advantage over other organizations, but also opportunities to be able to gain greater market share, or to be able to expose your customer base to something new or different. The 5th reason is to be able to deal with complexity. because complexity does come into factors into a lot of situations where it's not simple. And by having a system in place, by creating a mechanism that allows you to track how you're doing and how you're faring to your goals or past performances, it helps you to then figure out when things get really rough or becomes your processes become more advanced or the circumstances become more complex. So it helps you with that. And then, of course, it helps to decentralize decision making and facilitate teamwork. So what that does is it allows you to be able to have those that are on the front line be able to also make decisions versus it being a top rung decision where only senior management can make a decision about certain elements or phases. And then, of course, it brings everyone together because everyone is having to do their part in order to make sure that the goals are attained. So let's look at the steps in the control process. First, we're going to establish our standards. So what is it that we'd like to see happen? How is a product supposed to look? How is customer service at its best level supposed to be displayed? Then you measure that performance, and then you compare the performance to what your standard is. So what is being done to what you'd like happen. And then if things are not happening, if the performance is not up to par to the standards, you have to make corrective action. And so then if that corrective action is taken, then you may have to revise your standards. But if not, you continue to work your progress and recognize your success. So that cycle continues, right? So let's say you set a standard of that each rep would do 1,500 widgets a week. And that's what you set as the standard. And then you notice that the vast majority of your team members are only able to do 1,000 widgets in a week. And it's consistently 1,000 widgets. Maybe someone gets up to 1,200, but no one has reached 1,500. And you've tried for 6 months and it's been a year and no one has ever reached 1,500. So at that point, you take the corrective action and you have to make some tweaks. And that means that you may revise the standards, or it's the case if you have to revise something else. And it could be the work environment, it could be the way the widgets are assembled, whatever it may be. And so that's the process. So we looked at a diagram, so let's look closer from this way. When we talked about measuring performance, that is usually done through written or oral reports, also personal observations. So when I use the example of the products or the widgets being assembled, if I am the manager and I'm walking the assembly line, I can make personal observations as to how it's done. Of course, written reports are the fact that we're keeping account of all the various widgets, any defects, so on and so forth. And then the oral reports is anytime someone comes in, they just say what they're doing, what they've done, so on and so forth. And the concept of management by exception is a principle that says that you as the manager should be informed of a situation only if data is going to show any kind of significant deviation from the standards. So this helps to prevent micromanagement, where you're not having to come to the manager or someone's not having to come to you every single time there is some kind of deviation, right? It's only when it is really significant. So for instance, if the standard is 1,500 and you're making it to 1,490, no one's going to come to you and tell you, oh gosh, we've only made it to 1,490. No, that's not significant. Significant is if someone comes and they say, Joe is only making it to 800 consistently. That is a significant deviation from the standards. So that's management by exception. And the different ways in which we can take corrective action is that if we make no changes, We recognize and reinforce the positive performance, meaning that you're consistently reaching the standards or coming fairly close. Or we take action to correct negative performance, meaning that either that means that could be retraining, it could be reassignment to another task or another department, it could be termination, could be a number of things that could be the action that is taken. So here's a question for you. A UPS driver fails to perform according to the standards set for the route and traffic conditions. A supervisor rides along, gives suggestion for improvement. This is what stage in the control process? Is this how we compare performance to standards? Is this how we establish the standards, take corrective action, or measure performance? You as a driver, you're not reaching our standards. I as a supervisor, I ride along with you and give you suggestions on how you can perform. What stage in the control process is that? If you said C, you are correct. We're taking corrective action, right? Because we already know that you're not performing to standards. We've already established standards and we've measured your performance, right? So this is taking corrective action. So let's look at the levels of control. We have two right here are strategic and tactical. Strategic control is where we're going to monitor your performance to ensure that it is reaching up to the strategic plans that have been set in play. And we're making sure that those are being implemented and that if there's any corrective action that's needed, that is being taken. A tactical control is when we're going to monitor the performance to ensure that it meets the tactical plans. And those are usually broken down by either division or department. And we're making sure that those plans are being implemented. And so there are different kinds of mechanisms that are put into play depending on where we are in the planning process and the role of the individuals involved. So, for instance, in some organizations, tactical control is not necessarily used for those frontline managers with their frontline employees. Same with when it would come to something as far as strategic. But operational control is when we're looking at those day-to-day goals and how those align with the operational plans, right? Those day-to-day things that we're taking in consideration of every single moment. That's usually very much frontline, and we're looking at how those plans are being implemented, and then whatever corrective action that's needed is being taken. Oops, skipped ahead. Hold on a second. There we go. So there's 6 areas of control: physical, human resources, informational, cultural, structural, financial. And organizations find ways in which that we maneuver through these various areas of control and take in consideration that all 6 are very vital to any organization. Ignoring any of these or omitting any of these, you really do set your organization up for some major gaps and weaknesses. So a drug test employed by an organization is in its hiring process, and that's an example of what kind of resource. Is it physical, human, financial, informational? We're using a drug test in our hiring process. Would it be financial? It has nothing to do with tracking our money and tracking how it's being spent and how it's coming in. We're not tracking information. We're not tracking any kind of physical resource as far as property, things of that nature. So the correct answer would be B, human. It's dealing with our people. So let's look at our structural areas. We have bureaucratic control, decentralized control. And bureaucratic is characterized by the rules and regulations and policies and having formal authority. It's all the red tape, right? It's all the different levels in which we have to be able to get through in order to get decisions and to have things done in a more formal way. Decentralized control is an approach that is used in order to have more of an informal and a organic structure. It's I really don't want to say laid back, but what I'll say is that there's more autonomy, there's more flexibility, it's more room for people on all levels of the organization to have a say, to chime in, to make decisions. When we look at our balanced scoreboard, this is how your top managers, and these are your C-suite managers and so forth, your vice presidents and things of that nature. It gives you a very quick but very comprehensive view. So you get a broad view of how the organization is doing based on how well your customers are satisfied, the various internal processes and how those processes are implemented and how successful they are. It looks at innovation and any type of activities that are used to improve upon innovation, improve upon product and service delivery, as well as it looks at your financial measures. So it covers the gamut so that you can really see how healthy your organization is at a given point. So when you look at the forward perspectives, figure 16.5 shows you that when you look at the top one, it talks about the financial perspective and how do we look to our shareholders, how is our goals versus how it's being measured. And then you have your customer perspective. How do customers see us? Your internal business perspectives. Where must we excel internally for our business? And then your fourth one is the innovation and learning perspective. Can we continue to improve and create value? The important thing that organizations need to always consider is how can the company itself continue to improve? How can the products and services that you provide continue to improve? How can you create value? Because without value, there's no demand. Without demand, you don't have much of a supply. Without supply, without demand, there is no business. So making sure that all four perspectives are taken into consideration. And so when we talked about the financial earlier, I mentioned the money. That's what it comes down to. How profitable you are, is there growth, and how much of that translates to value for shareholders. Customer, making sure that you're taking care of them, that they are a priority. And then, of course, internal is looking at productivity, employee skills, quality, but also making sure that you're taking care of your employees. Because at the end of the day, without any employees, it doesn't matter how many customers you have. Without employees getting the job done, you can't serve your customers. So making sure you're taking care of the internal elements and aspects of your business. And then innovation and learning is constantly learning and growth of your employees. Then we have a visual representation of your scorecard, and that's a strategy map. And that's where you take those four perspectives and you actually communicate the goals so that everyone in the company can understand how their jobs are linked to the objectives and goals of the organization. So it gives you something visual to work with because you're taking into consideration that everyone learns and translates information differently. And so if you can then be able to create something visual, and then I can see how the dots are connected, and I can see how I play a role within this this strategy, within this goal, within this concept, then I can actually have greater buy-in to making sure that we can actually reach those goals and objectives. So here's figure 16.6, and here shows we can see a strategy map. And I'm going to see if I can actually enlarge it, and I'll scroll it. But you see with the financial goals, and we have our long-term value where we connect the productivity goal and our revenue goal, and then you see the customer goals with the operational excellence, customer intimacy, product leadership, and internal goals are the innovation and increased customer value, good corporate citizenship, um, learning and growth goals, making sure that we have um, our workers are competent and highly skilled, and that there's supportive values and practices that are implemented, and effective information and technology systems, right? So when you have and how all of these, if you see all of these plug right into your long-term value, they all feed right in. Oops, let me go back. 1 second. Make sure I cover it. So that is how a strategy map broken down based on the goals. And then what you could do is build upon that strategy map, and you'd have a separate one so that everyone could see how they play in to each of those core goals. Now, why certain organizations succeed over others? And when you look at measured organizations that are measured, right? They use various control systems. Why they succeed over others is because you have the senior leaders at the top agree on strategy, right? They agree on this is where we want to be in 20, 50 years. The communication is clear and concise. There's no gray area. It's very white and black. They understand it. There's a better focus and alignment on where they're going, what they plan to do. And the culture of the organization is focused on teamwork, and they encourage and allow risk-taking. When you're so regimented and so highly structured and restrictive that you don't, that everyone is pitted against each other, and it is a dog-eat-dog kind of environment, and it's fear-based, and everyone's too afraid to take any leaps, then what happens is that you have analysis paralysis. You have people that don't move forward. You have people that are very stagnant. And so it really does limit the amount of innovation and growth that you could potentially have. So all of these 4 factors really do come into play. Here's some things that can actually serve as barriers. If your objectives are fuzzy, meaning they're not clear, people cannot interpret it clearly, each individual that speaks about it has their own interpretation as to what the objectives are and how they're to be reached. That's fuzzy. If there's too much trust placed into informal feedback systems by your managers, that can be a barrier, because the thing is that it means that you're not being able to track certain things. So informal feedback systems could simply be an oral, like I just shouted it and just said, yeah, this is how I'm doing, or I sent you a quick text. It's too informal. So you do need to have a balance of having some formal feedback system where there's some actually written reports. There's different mechanisms that are in play that can help you track where you want to be, where you are, and if there's any deviations. And another barrier could be as if your employees resist any of the systems that you're trying to put in play. I mean, that's like, trying to, herd cats. It could be very difficult. And then finally, if you as an organization focus too much on measuring activities instead of results. So if you're more focused on seeing that everyone's doing the same thing, but you're not concerned with at the end of the day that the job is done, then that could be a barrier. Because as an employer, as a manager, I'm more concerned about the job being done. I don't care how it's getting done. Is it being done, and are we reaching those target deadlines, those dates, or coming close to it? Now, if we set for December and we don't reach it until the following December, there's a problem. Houston, we've got a problem. But if we set for December and we reach it in January or February, okay, we can look at how we deviated, we can work with it. But am I going to be so concerned that I need to see everyone in their seat doing this, logged in, blah, 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 everyone, no, let's just focus on results. So there has to be a balance, of course, right? You don't want to give someone too much leeway where there's no rules. We all need rules. We all need to have some kind of structure. But let's make sure that it's not too much of a focus on one or the other. So Jeff has a sales goal, and it was to improve sales. But there's a barrier. What is the barrier? Is his objectives too fuzzy? Are managers putting too much trust in the informal feedback system? Is he resistant to new measurement systems? Or is the company too focused too much on measuring activities? His sales goal was to improve sales. If you said A, you're correct, right? It's fuzzy. What does that mean? What does improve sales mean? What do you mean improve sales? You want an extra sale? Is it the customer service part of sales? What do you mean by improve sales? So it's too fuzzy. So let's look at some formal financial projections tied to budgets. Budget is a formal financial projection, and there are incremental budgets which allows you to allocate increase or decrease funds to a certain department. And what you do is you use the last budget period as your reference point. So then you know where you're too high, too low, you know how much wiggle room you have. And this is done when a budget request is submitted and reviewed. Right? That's the only time change is done. We have different types of budgets, and 16.1 in your textbook shows you some. There's a cash or cash flow budget that is going to forecast and project to you all the different sources of cash income that you have, as well as any expenditures that you have for daily, weekly, and monthly periods. It can be 1, 2, all 3, or you can also do a quarterly period. And then you have capital expenditures budget, and that helps you anticipate various investments that you may have in buildings, land, as well as in major equipment. Sales or revenue budget is how you're looking at the future sales, and that's usually done by a sales area, month, or by a specific product. And you want to see the sales or the revenue budget for a specific product. Then you'll see the expense budget, your financial budget, operating budget, and non-monetary budget. Your non-monetary is usually hours of labor or square footage in your office. Your operating budget, that's the various projects that you are going to create in various goods or services that your company produces, and you're looking at what kind of financial needs resources that you need in order to create that good or service. And then you have to look at how much income that you're expecting to bring in. All right. The financial budget looks at it projects your where you're getting your cash, what you have on hand, and how you plan on spending it in any kind of upcoming periods, whether it's quarterly, annually, so on and so forth. So we have a fixed and we have a variable budget. A fixed budget is where it is based on a single estimate of cost. Is a recurring. This is what it is every month. The rent is $3,000 every month. The insurance is $500, so on and so forth. A variable budget allows the allocation of resources to vary in proportion with various levels of activity. So that can take in consideration that we possibly did if some various had different events, or we acquired something, whether it's property or another business, so on and so forth. So there may be some adjustments. And it could also, variable budgets can also take in consideration hiring, whether we're hiring, having a spike in our hiring, or if we're also doing a major layoff. So our financial statements that you will review, monthly, quarterly, annually, you'll have your balance sheet, and that summarizes your overall financial worth. You're looking at your assets and liabilities over a specific period of time. You have your income statement that's going to show your revenues and expenses over a specific period of time. And we have different ratios that we analyze. We look at how easy an organization can convert their assets over to cash. That's your liquidity, how quickly you can become liquid. A lot of organizations don't have a lot of cash on hand. You have a lot of things tied up into various assets and that have only value on paper, but until you can convert them to cash, that's when you can really see where you are. So looking into that. Your debt management ratio is how you're able to meet any long-term financial obligations. A lot of organizations will sign contracts, multi-year contracts, and so and that could be to a vendor or whomever, and you need to see your ability to be able to pay off that debt. Your return ratio is how effective you are at generating a return or profit. So if 10,000 is invested in, how quickly can you recoup that 10,000, right? How quickly are you able to get that 10,000 back in sales? And not only getting a return on that, but what if you're able to recoup the 10,000 plus another 10,000 so that you actually have a profit on top of it? Then there's some audits, both internal and external, and these are very valuable and vital to the success of an organization. That's where you're going to formally verify your financial and operational systems. You're going to look at every penny that goes in and comes out. You're going to look at how every element of your organization is running and whether or not it's well-oiled or needs some WD-40, right? So externally, you can have some outside experts come in. It can cost thousands and thousands of dollars to do. And internally, you can have your own professional staff come in. Now, internally is great when you're talking about just needing a basic overview. You just need to make sure that everything is running well. But if there's any major hiccups or you are required by a governmental agency, an external audit will always be conducted. And it's usually done, it could be done annually, depending on the requirements. It could be something that could be done every 5 years. It really depends on the agency. So then there's dimming management, and this is looking at the quality should be aimed at the needs of the consumer, right? What does the consumer need? That is how your quality should be aligned. And so companies should aim at improving the system, not blaming workers. This is something that I stand firmly by. How can we improve the system? There's nothing worse than seeing a manager on any level demean and degrade and disrespect a worker, blame a worker. You are responsible for creating a system and making sure that system is always improved upon, and you are responsible for equipping your workers with the resources and skills that they need in order to do their job. So rather than blame them, improve the system. Keep tweaking the system until that worker can do the job. Making sure that you improve the quality leads in order to increase your market share, right? And what that means is that you're constantly going out and you're hitting that pavement, not literally, but figuratively, to be able to get new leads for new clients, for new vendors, for new widgets, for new whatever, and so that you're able to produce more that quality products and services so that you can gain more customers. And when you have more customers, you have a greater market share. You have more people buying from you than your competitors. Making sure that you increase your company prospects and, of course, increase employment. One of the most valuable things you can do is be an employer of hundreds or even thousands of employees. And then, of course, the quality can be improved on the basis of hard data using the PDCA cycle that you'll read about in your textbook. That hard data is something that is in some ways considered irrefutable. That you can see it, it's quantitative, it's there. You know that there was 10,500 widgets, only 10,420 are accounted for. All right, that's hard data, right? So, and of those 10,420, 85% were high quality, 5% were mid-range quality, and you have 5% that were just lousy. All right, but it's all hard data. So here's the PDCA cycle. We're going to quickly go over the 4 steps. Figure 16.7 shows you plan. So you plan your desired and your important changes based on any observed data that you have. You can even come up with a pilot test, and usually pilot tests are 12 to 18 months, depending on the extensiveness of the of whatever you're trying to implement. Some may just be a few months. Then you're going to implement the change or make any of your little small scale tests that you need to do. You'll check or observe what happened after the change or what happened during the test period. And then whatever you learn during that time, you're going to act upon it. All right, you're going to determine if your predictions can be made as a basis for new methods or whether or not it's something that just kind of happened. And so those are the PDCA. So it's plan, do, check, act. So TQM, some of you are actually work within quality assurance and TQM, which is total quality management, and that's a comprehensive approach. And it's usually led by your senior managers, the top at the organization, and supported throughout. And the focus is on making sure that quality is continuously improved upon, that training is consistently improved upon, that training is always coming up with new and innovative ways. It's keeping everyone engaged, keeping everyone on top of what's going on around the world and in the market. And that, of course, customers are always satisfied, and finding ways in which you can keep your customers satisfied. So there's 2 core principles of TQM: people and improvement, and making sure that everyone in the organization is focused on delivering value to customers, and that you're also committed to improving the processes of the work being performed in the organization. With your people orientation, your customer value is most important, and TQM requires that training, teamwork, and cross-functional efforts are at the highest standards. And with our improvement orientation, there's a strong commitment from top management. It's less expensive to do it right the first time, right? It's better to do small improvements all the time, not where you're not having to do these major improvements in these random times or these huge gaps of times where all of a sudden it's once every 10 years. But if you're constantly making small improvements, then it saves a lot of time, it saves money, it saves the leeway into being able to get something done, and it also allows you to reduce the potential of having to bring in certain kind of specialists or being in over your head. Now there's a Rater scale, and the meanings of the Rater dimensions are reliability, assurance, tangibles, empathy, and responsiveness. And this enables customers to rate the quality of a service among those dimensions. Your reliability is your ability to perform the service dependably, consistently, accurately. Assurance is how knowledgeable you are as an employee, how courteous you are, and how much can you convey trust and confidence to not only your customer, but to your coworkers and to management. Tangibles are your equipment, how your team members look, their appearance, how well they are put together, the physical facilities in which you work. Empathy is how much care and individualized attention is given to customers. How willing you are as an individual to provide prompt service and help customers is your responsiveness. So when we look at some of the techniques, we have outsourcing, reduced cycle time, the ISO 9000 and 14000 series, statistical process control, and then we have our Six Sigma and our Lean Six Sigma. all of which you read about in chapter 16. So in Harvey's job, he takes random samples of production runs to ascertain quality. Is his job involving benchmarking, statistical process control, reduced cycle time, or feed forward control? He takes random samples of production runs to ascertain quality. If you said B, you were correct. So, to look at some of the keys to successful control systems, they are both results oriented and strategic. They're accurate, timely, and objective, realistic, positive, understandable, and they also encourage self-control, and they are always flexible. They cannot be fixed and rigid, right? They have to be flexible. It has to have an ebb and flow. Some of the barriers: too much control, too much focus on paperwork, there's more focus on means instead of the ends. There's not enough employee participation because all the managers are trying to control everything. There's overemphasis on one thing instead of multiple approaches. You got to be able to hit things from all different angles. If people actually looked at control like they do sports, they would have a better understanding. If you consider when sports, it's constantly changing, it's evolving, and there's so many unpredictable things that you have to be able to come at something with different approaches and be able to change something up on the fly. And it requires all the team members to be actively involved, right? And the coach may not always be right. Sometimes the player sees something the coach doesn't see, and that player can make a tweak or recommend an adjustment to a call being played. So these are the things that if businesses actually thought that way, they'd be able to perform better. So when we consider managing for productivity, productivity is your output over your input, or better yet, when you look at the figure right here, you'll see you have your goods and your services and how those are divided by the accumulation of your labor, capital, materials, and energy. And productivity is important because it helps you determine whether or not your organization will make a profit and how it affects the standard of living, right, within a country itself. Actually, all of that plays in. So when we look at figure 16.8, you're the manager, and so you have to operate in a complex environment, and you're looking at the competitive advancement and ethical standards and your happiness and your goals. And then you have to be able to make decisions about the 4 different management functions: planning, organizing, leading, controlling. And all of that takes into consideration and how they all play in is so that you're able to achieve productivity and realize the results that are needed in order to be successful. So we look at IT and how this plays into control. And we have ERP, which is your enterprise resource planning, and those are information systems and software systems that are integrated virtually into every element and aspect of your organization. And it helps you as the manager stay on top of all the different developments that are taking place internally as well as externally. So here's some keys to your success as a manager. You have to find what you're most passionate about and follow it. If you're not passionate about it, it'll fizzle and you'll burn out. You have to be able to be realistic, encourage self-discovery, understand that every situation is different, so you must be flexible. You cannot be rigid. The best managers are not rigid, they are flexible. And you have to fine-tune your people skills. There's nothing worse than a manager who believes that those that follow them, that their team members should adapt to them. I will always say that a great leader, a great manager, is one who adapts to and fine-tunes themselves and speaks the language of the people that they want to follow them. Because at the end of the day, if you find yourself walking down the street and no one's behind you, You're not leading. You're just walking down the street by yourself. And that's how it is also in business. At some point, people will stop following you. People will stop listening to you. People will just start to quit. You have to also be able to learn how to develop your leadership skills, as I just said. Treat people as if they matter, because they do. They're not just numbers. They're not just paychecks. They are people. They have hearts. They have feelings. They have families. They have fears. They have weaknesses. They have strengths. They matter. As I said earlier, it doesn't matter how many customers you have. If you have 0 employees to do the job, guess what? You don't have a business, because eventually those customers go away. You have to be able to draw employees and peers into your management process. Draw them in, lure them in, entice them in, encourage them in. Be flexible. Keep your cool at all times. Take yourself lightly. Right? If you take yourself too seriously, you're going to burn out. And before long, something bad is going to happen. And then you serve no purpose. All right? If you're not around, you serve no purpose. So those are the keys to your managerial success. If you guys have any questions, please don't hesitate to ask me. As you can see, this is a different breakdown from previous examinations of the control system, but now you can kind of go deeper and you really get a greater look. With that, we will wrap up chapter 16. I hope this has been helpful for you.